markets. But with central bank activity behind us last week, the Fed right now around the corner in March, I want to take a look at the currencies with our next guest. Traders, we've got Alan Nuckman, Chief Market Strategist at Agora Financial, with us here on Futures with Lichtenstein and Hinks. Alan, last week it was the ECB, the Bank of Japan, the Bank of Australia, and Bank of Canada. They all left rates unchanged. Not one of the central banks felt the need to raise rates. All noted weak inflation. They all want to raise, but much like what we're dealing with here in the U.S., inflation remains soft.
Yeah, well, we're going to lead the way. We're going to raise rates. It's a done deal. It's happening. And what's interesting here is the market action is really stalled in some of these currencies and some of these interest rates. Looking at the dollar index was flatlining last week, and the euro currency, like I said, is not over, is still holding around this 124 level. So everybody's waiting for the next price movement to give us an indication of where the future goes.
Alan, let's talk tariffs for a moment. It looks like, depending on what trading vehicle you go to, it's different reactions to tariffs, right? I mean, the oil markets are reacting. The grain market certainly reacted Thursday and Friday.
Right.
The stock market had its reaction. Give us your thoughts on tariffs and how they're impacting individual parts of this economy.
Well, the tariff issue, I think the markets move forward. I mean, look at the price action in the S&P. We had the NASDAQ make new all-time highs. The S&P now is back to that Tuesday ago top. It was just the highest level since the stock correction. So it looks like we're back on the march again to make new highs in the broad market. Now, I've said this before, that if you see a V recovery again, that targets 32.25 in the S&P, which is about 17% above where we are here. So it's happened every time in history. I'm not going to say that it's not going to happen, but that's in the face of this tough tariff talk. Now, individual segments have suffered a little bit, but it may be just short term. I think that you talked about crude oil making a nice, healthy comeback. I think that that's back as you see assets reflate. The grain thing was interesting to me because it was a delayed reaction. Obviously, you know, we've got huge customers in China for our soybeans, 60% of our beans, and Mexico is a huge corn market for us. So we don't want that to get shaken up. That could cause some major disruptions as far as delivering these supplies from America's breadbasket. But I don't think in net that this tariff situation right now is going to have much impact in the market, and that's what the price has shown us if you look at the broad stock market.
Alan, if it does start to impact the market, if it does actually start to get nations kind of getting a little bit combative and pointed in the direction of possible currency war, I'm curious what that would mean. But then sometimes I think about it and I'm like, wait, by definition, we're actually already in a currency war right now. I mean, we're all trying to keep our currency lower and lowering the value of the currency. So are we already in a currency war?
I very much think so. It's been a race to the bottom for many years.
Sure
I mean, that's just the way it works. And the dollar is just a great example of that. You know, we've talked about how this president is going to do what he can to support the stock market. And I don't see the dollar getting very strong because that hurts that overall plan. What I think is interesting here is we keep talking about interest rates and what impact that's going to have. But if you look at the 10-year note over the last month, we've been in a 1-point sideways range. We had a key reversal top, and the interest rate rise has stalled. So I think the worst may be over as far as that goes. And I'm actually looking for a short squeeze because everybody's on one side of the boat as far as everybody's been positioning for interest rates in one direction. And we've seen this before in the last couple of years. I think we could have a little bit of a corrective move to kind of shake things up a bit.
All right, we just had the ringing of the bell there. It's the bottom of the 7 o'clock hour here, Alan. We're going to take a quick break, but stick around because you touched on the dollar. I'm going to dig into the treasuries a little bit. We'll get into those financial markets right here on Futures with Lichtenstein after this short break.
So, Lionel, what does being able to
Well, central bank activity last week, again, all four leaving rates unchanged. Does this change the reaction or the activity that we should see from the Fed coming our way? We still have Alan Nuckman joining us here today. We're going to be talking currencies. We're going to be talking treasuries with them. Alan, thanks for sticking around through the break. How does central bank activity leaving rates unchanged impact the Fed? I know you think the March rate hike is already a done deal, but moving forward, does this slow them down in terms of, and if so, does this change the price activity or impact or your outlook on the dollar?
Well, I think we have a plan in place where we're going to raise rates a quarter of a and we get there. But until proven otherwise, I'm going to be going with that assumption for right now. So it should be a slow, a gradual, and we've got good numbers on Friday that support that, because not only did we get the better than expected job growth, but we had a little bit of weakness. I wouldn't say weakness, but less strength. Let's use that phrase. Less strength in the wage growth number. So that kind of is more of a Goldilocks scenario for everything. So the question is, the dollar, will it turn back lower? I think so. That we had some solid strength last week in the euro currency, the Japanese yen as well. I think the dollar is stalled right now, but in the next turn could be lower, and this could be a fake out breakout to the upside, and that would be a positive for a lot of other markets.
Alan, as you know, the bonds are sitting on their 2018 year lows here and seem to have, some inherent weakness in the futures, right? Even though this is a busy price, make no mistake, as we hit 2.9% on the 10-year this morning, tell me what you think. I feel this is going to be a very lumpy, bumpy trade here between 2.9 and 3%. Tell me what you feel about bonds here.
Well, we've stalled. It looked like it was going to attack that 3%, and we haven't pushed up to that level. Now, I'm looking at kind of a near-term topping formation. You may see some counteraction after the fact when we actually raise rates here in March. We've talked about the long-term rates, are governed by supply and demand. And I'm looking at an actual reward to risk play that I think would take advantage of if there is a squeeze. Like I said, everybody's short. Everybody is short. So I think you could see a little bit of a squeeze. Now, I'm looking to play this using TLT, which is an ETF that is a 20-year bond. That right now is trading around 118. You can buy an in-the-money call for June, a 114 call that's $4 in the money. That option's trading at about $5. So if we do get a bit of a squeeze here, this is a great reward to risk play. It's got 3 months of time for something to happen. I'm just uncomfortable, and I always get uncomfortable when everybody has one opinion, and that's what we have right now in treasuries.
Alan, let's keep with the treasuries here. I want to talk a little bit about the supply issue that seems to be kind of coming into play here as the Fed's less active and expectations are for higher rates to come. I'm curious, will this force us to address our deficit spending issues sooner rather than later? And as U.S. debt and current levels, can we even handle higher rates to come?
Well, it wouldn't be pretty if rates get moving very fast, but that's why this measured gradual move is very important, and it's outlined every time the Fed talks. So yeah, we don't want higher rates from that standpoint. It's interesting that debt discussions get put away when they want to and then taken out when they want to use them against somebody, but that's just the nature of it. To get back into what I think is kind of forgotten about is the unwinding of the portfolio by the Fed. They don't have to sell their positions. They can just let the positions go, and then that shrinks the balance sheet. So that used to be a concern, but I think that's going to have a minimal impact as this portfolio comes due. Think about it. They're making money every quarter on that bond portfolio. So to me, it's a no-lose situation.
Alan, let's dive a little deeper into your theory about what's coming up here, because we have a Fed meeting coming up March 21st. That's 9 days from today.
Right.
And I believe you're exactly on point. There is a history, if you look at the chart, of bond futures rallying off interest rate hikes. right? At least short term. They actually do move higher. You know, we've seen it a couple times here. Is that what you're thinking? There could be a short term little squeeze in bond futures coming off what appears to be an obvious sale, right? But these markets never do what is obvious.
That's the point. That if it looks that easy, it's usually not. And we've seen this time and time again. So we'll see if it happens one more time. But I'm just noticing that, you know, the opinion is so overloaded to one side as far as rates going higher. So we've been in this situation before. If you remember back to 2014, everybody convinced that the bottom was in. It wasn't. So I think, you know, in the long term, yes, rates will slowly move higher, and you know, that's just a function of a healing market. But I think we got a bit ahead of ourselves, and we could get a little bit of a squeeze here in the short term. I'm not talking about a whole lot. I mean, we come back between 2.5% and 3%. Let's say we come back down under 2.75 and kind of shake the tree a little bit. But you know, I'm not looking for it looking for yields to get buried. I'm just thinking that I would rather be a seller of yield and a buyer of treasuries than the opposite at this point.
Alan, I'm watching the 2-year versus the bonds. A few weeks ago, or a couple months ago, I guess it was now, there was a lot of talk about the flattening of the yield curve and inversion potentially. Is this still a concern? Because the 2 years actually continuing the slide right now, even as the bonds hold above the 142 handle, hanging out around 143 right now.
Yeah, I think that's kind of been alleviated here in the short term, and I think it comes back to the overall confidence in the stock market making a big comeback. So you know, people were looking for signs of of recession in the future, but looking at stocks, the way things have boomed back, another huge comeback, and looking like we want to attack those highs one more time. I don't think that those that inversion, or like you said, that flattening is an issue right now.
Alan, let's talk about the magic number, which is 3% in the 10-year yield. Tell me what you feel. I think it's the pace. It's all about rising rates, in my opinion. The stock market is going to react to the pace of interest rates rise, not necessarily if they're rising. Tell us your thoughts about a 3% yield, and what overall, is it just psychological, or is it just something we should all pay attention to?
Every day I remind myself 3% means nothing to the market.
Right.
It's just a number. You know, we're all focused on this, and actually it's a level we can lean on as a trader, and that's taking a position here that I think there's more downside in yield right now, potential as a trade, than there is upside here. To be a buyer after we've rallied up to 2.9, you know how much is it going to blast through 3.0? I don't. I'm positioning right now to look for a little bit of attack on the downside, a little bit of profit taking, because once that ball gets started and some of these stops get hit from all these positions that have built up over time on the short side, you know, once those stops start getting hit and people have to, you know, people can put some of that money in the bank, then you could see the markets move the other way. And that's how I'm looking at things right now. Could be wrong, but until we close above 3% on a weekly basis, I still have to respect the overall trend is down in the big picture.
Yeah, well, we're watching that 3% level. We'll keep a close eye on it. Alan, thanks for coming on a Monday morning. Appreciate you sharing some of your thoughts with us. That's Alan Nuckman from Agora Financial. Kevin, let's transition from the